So welcome back to Real Estate Syndicate Alive, episode 63. And today we're going to be talking about how to buy and underwrite in today's crazy market and navigate these crazy and challenging times. And I'm super excited because I've got my good friend, Alix Kogan on the show today. And Alix is really an industry veteran with over 20 years of successful real estate operations and over $500 million worth of transactions under his belt. Alix has been involved in all facets of real estate, construction, and development since he embarked on his career in real estate over 20 years ago. Alix grew his business and became one of the largest and most successful single-family, mixed-use, townhome, condos, and small subdivision construction company in Southwest Colorado. So talking about somebody who has all kinds of asset experience. He ultimately sold and realized a successful exit on those. And over the last few years, Alix has been divesting from most of his single-family and smaller commercial assets to focus strictly on multifamily, and has been successfully doing so through his 12 acquisitions as a general partner. Currently, Alix owns about 1,500 units and over 1,250 beds as a GP. And maybe more importantly, he has become one of the, I was going to share this screen. This is such a great screen, my friend, but I'll do it later. But anyway, without further ado, let's bring on Alix. Alix, how you doing, Alix?
Hey, Mauricio, great to be here.
I was going to show off that you are literally, I'm looking at my screen now, maybe I'll bring it up later, the 7th most popular video on my YouTube channel. I've done over 200 videos. You're number 7, our second most popular guest. So super excited to have you back. And let's get right into it, right? So we do a lot of these syndications, right? And we have a lot of clients who are telling us, dude, there's nothing out there, with interest rates going through the roof, cap rates, cap rates going up, rate caps going up. Cap rates going down, or actually going up. There's just nothing out there. Nothing pencils out. And then I got other clients who are like doing 1 or 2 deals, every month or so. They seem to be finding deals all the time. So where do you fit into the spectrum? Are you on the fence that there's nothing out there, it's really tough, you've got to really be conservative, or are you finding a lot of deals out there right now?
We are, for one, we're much more conservative in our investment thesis. We could talk about that, but the market is a bit frozen. So we just closed on a nice student housing deal a couple of months ago, and that's it for the whole entire year. So it is, in my opinion, based on what we buy, it's very slow. There's the obvious bid-ask spread between buyers and sellers. So if you are a seller, there's no reason to sell in this market unless you're a forced seller. So that obviously creates a challenge. All sparked from the interest rate environment that we're in and the cap rate environment.
Yeah, and so what type of adjustments then are you making? I mean, I presume well, let me ask you, has your underwriting guidelines changed since 6-12 months ago, or what? Let's get some into the details. Like, what are some of the things that you're doing today that you weren't doing 6-12 months ago when before the interest rate hike started really kicking in?
Sure. So I guess we'll start with the type of assets that we're buying. Historically, we've bought across the spectrum. We've bought C-class, B-class, A-class, conventional, and student housing. So we're still doing both of the main asset classes, student housing and conventional. We've done more student housing in the last 12 months than we have conventional. But probably the biggest area where we've shifted is we're not comfortable with C-class value add. That was, the buzz for the last few years, and everybody was trying to buy a C-class asset, renovate, push rents, that forced appreciation. We think that that's a risky proposition today. We think that floating rate debt, for one, is risky. Look, you can do it if you're absolutely sure you can execute your business plan and you've got everything just completely shored up and your underwriting is right. But that's not even something we want to risk today. So all we're doing right now is fixed rate debt, and we're not doing heavy value add. So we've shifted from that. I don't like at least what we've seen in our portfolio in some of the C-class assets where renters are feeling the effects of the economy. So they are paycheck to paycheck. So if you're going to do a value add and you're going to force appreciation and raise rents, it doesn't work as well as it did 12 months ago, 2 years ago. It's people just don't have as much tolerance to be able to say, hey, I can absorb 100, 200. In some markets, yes. So you really have to understand on a very, very granular level your comp set. What type of demographic do you have? What's the average income? If they're making $35,000, can I raise their rents to $1,800? I don't think so. So you really have to understand the supply and demand dynamics. So if I'm raised rents here, is this, if I lose that renter, is it okay that there's enough efficiency in the market that I'll get another renter, that the supply and demand dynamics are healthy? But the days, I think, of just, assuming, which is, I think, the problem that everybody did, just very kind of shallow surface underwriting, making all these assumptions. Yes, I can get 100, 200, 300. And their comparisons are so generic as well. They see that like a 1990 asset's getting $200 more, and they think, well, why can't my 1980s asset get $200 more, without really understanding, the submarket, all the other various dynamics that we spoke about. So I know that's a mouthful, but all said and done, we are just, granted, we're a little gun shy. I don't want to, and the good thing is we don't have to buy anything, right? I think that's a difference between us and some. I think there's some sponsors that are not well capitalized as a company, and they just have to have the deal flow and the fees and that snowball effect. I'm just not going to buy. So because of that, we're much more scrutinizing on every single detail of our underwriting. And I'd rather make less. The theme for us is, and our investors, that had lots of conversations, that we don't want to take as much risk, but we're also willing to take less return to mitigate the risk and get through this next couple of years and then pivot with the market. You can't force the market. You gotta basically be able to pivot within the market.
Yeah, it's the first time I've actually heard somebody say that, because usually what I'm hearing is that the reason people either don't like value add anymore or it doesn't quite work anymore is just simply because all of that value that you've added because of the renovations you're making, all that stuff, that CapEx you're doing, gets taken away from the cap rates. Cap rates, I think for every one cap rate it goes up, your property goes down 20% and basically wipes out whatever equity you would have received with that value add. And of course, the plan there is to refinance. But you're saying actually you're seeing a lot of pressure from tenants themselves, that actually the market isn't bearing additional rent hikes. That's kind of what I'm hearing.
In certain asset classes. So not only is it harder to get renters to accept rent hikes, but you also have the renovation costs that are all over the place. I mean, one day you're getting it done for $10,000 a door, then it's 15, it's 20. The costs are all over the place. So I think that's a challenge. And then ultimately, you're likely buying something that's not stabilized. So you're putting on floating rate bridge debt. That's another variable in risk. So if all said and done, if you tally up all the additional risks, and let's just pick a number, let's just say you're going to do a value add, and on a investor level, that's a 15% return. You're taking on a lot of risk as compared to, I'd rather do a deal that has half of those variables that are non-existent, that I've mitigated the risk on, and I'm getting a 12, 13 return. So a couple 2-3 point difference, I'll take all day long. And that's really how our thesis has shifted. So we're always looking, how can we de-risk that deal?
Do you think that's getting any better? Is that stabilizing in terms of the market? Or do you think with, we've been talking a lot about recession potentially down the road. Do you think it's going to get worse, or do you think it's kind of bottomed down and we'll start to see people being able to support higher rents here shortly? And before you answer that, Alix, if you guys are listening, just, if you want to ask Alix a question, I see Tice already put some questions there. Just drop question in the comments or in the chat, and we'll get to them. But yeah, do you think a recession is coming, Alix? And how's that going to affect the value add strategy?
If I could tell you if a recession's coming or not, I'd be the magic man. I can't. I mean, it feels like, I don't think we're going to hit something, again, anecdotally, and just from my vantage point, I don't think we're going to hit something severe, but we're going to kind of coast into something and then hopefully quickly coast out of it. As far as how that affects us as real estate investors, I think it's really geographic, and going back to the term that I'll overuse 100 times, is very, very granular. Understanding what kind of submarket are you in? What kind of demographic do you have? Are these guys in an industry that is actually being affected right now, or are they in an industry that they're still making good money and their wages are growing? So you may have more ability to raise rent. So you have to, I think, really understand that. And too many syndicators, I think, and we've been suspect of this as well. We're in a lot of different markets, right? You really have to know the specific submarkets and the demographic that you're going after.
Yeah, I mean, always, real estate, as we all know, is super geographic and even asset class, which I know we're going to talk a little bit about some asset classes here. Tice, I think I'm pronouncing that right. Tice was asking, hey, I appreciate you addressing some of these crucial topics. My question is, how do you ensure you stay competitive in bidding for properties while maintaining a prudent investment strategy? Are you still seeing a lot of competition out there when you guys are putting out offers? Are you still competing with, 20, 30 offers like in the old days?
I mean, there's competition. I would say that there's not as much competition because there's a lot of people on the sideline. But if you think about the fact that there's less deals coming to market from the comment that I said previously, why sell today if you don't have to? So then all of a sudden, if you think about the people that have to sell, that have some motivation, well, there's less deals. So that means there's less deals for all of us to bid on. So you still have the same, maybe not the same, slightly less bidders, but you have enough bidders. The problem is there's still, how do I say this diplomatically? There's still a lot of dumb money that are way overbidding, that don't know how to underwrite, that are just getting crazy aggressive. I mean, there's some people in the Facebook world and in our social circles that I know are buying a deal today that we were $3 million less. I just don't know any possible way they'll make money. They'll probably break even at best, but they have a huge risk of losing money. So you still see that. And I just say to myself, why are these people still doing that? And if you dig deep, you get into some of those dynamics of they sort of have to keep the lights on and keep this thing going.
Yeah, I've heard this so many times where I've actually had people who are selling their property because they just want to get rid of them, and then they see all the bids on the property and how they're blaming the poor management and all this stuff. But it's funny to me to always see how some people will underwrite it. They'll be way so far off the underwriting, and then somebody else will come in and get the property. Do you think that's is that because people don't change their underwriting, or do change their underwriting guidelines because they are now up against a bidding war? To Ty's, I hope I'm pronouncing that right, Ty's question. I mean, is that?
Yeah, I think a lot of people are not adjusting their assumptions in their underwriting. So, for example, I can't tell you how many people, relative to our previous podcast, we talked about my KP role and I'll help guys. I continually see deals sent to me with just a generic, 3% rent growth year over year. And when you ask them what conviction and why do you have in that, there's no thought process. They haven't really even studied the metrics. They haven't even run a CoStar report that says, hey, here's the supply and demand dynamics. This market's supposed to grow X percent. It's not defensible. So there's still a lot of guys that are relying on the plug and play underwriting spreadsheets. And that's it. They're just like, hey, here's 5 comps. I think I can get $100, I think. And I think I can get 3% rent growth once we stabilize at that number. A lot of guessing. And how can you be competitive? What really is
let's get to the nitty gritty. So how would you go about if you had your underwriting at, let's just say 12 months ago or 18 months ago, you were underwriting X rent growth? What are you doing to change that or to come up with a different number? Presumably it's lower, or maybe just keep it flat. What's your process for changing your underwriting guidelines, or how are you coming up with these numbers?
We're just spending a lot more time in our underwriting market specific, right? And then asset specific. So some of the comments I made before, do we really believe that this demographic can afford, and how much can they afford? What's the average household income? What are their options? Really understanding what your comps are. Once you know that, you know where you sit. You know that, okay, look, We can see here's a use case. Here's a use case of other comps doing this. I think we can, grow our rents to here. And then there's data out there that'll tell you, where is that sub-market heading? Is it heading for growth? Is it flat? Is it going down? So there's data out there that at least that can help point you in the right direction on some of those metrics.
Yeah, I was gonna ask you about the data. Do you rely on your property manager at all, or a lot, or a little, in terms of, hey, what rents do you think you're going to be able to get when these, if these units are updated, or where the market currently is? Is that a good source, or do you rely on other sources?
It's one data point, but it is not my end all be all. I can tell you that we work with a handful of third party PMs, and every day and that's a topic we should talk about, how to sort of survive in this environment. And remind me to talk about asset management in a minute. But we rely on them, but it's not the all end be all. We'll look at data, and then we'll do our own comp set, our own mystery shopping. And it's amazing what you'll actually learn from talking to your comps, because the property manager or the leasing agent, you'd be shocked at what they will tell you. You walk in, you say, hey, I'm looking for an apartment. Hey, who are the major employers around here? How much pushback do you get on rents here? How much pushback do you get on amenities? What does this asset have that your comps don't have? Who are your comps? I mean, it is just amazing. How many units have you renovated? What are you guys spending on renovations? If you ask and you aggregate all this information, you're going to learn a tremendous amount of information that are going to either make you nervous or make you comfortable in your thesis. So it's a lot of just really intense due diligence, both on the front end before you even make an offer, and then of course, and the problem is, a lot of guys want to shortcut that process, because they don't want to fly out, visit all the comps, really understand that market, invest the time and resources before they even make a deal. They want to get in it, throw out 500 gazillion LOIs. Look, something's stuck. It's real. Let's go figure out that market. That's what I see more often than not, and that's a recipe for disaster.
Yeah. Next level says, regarding rent comps, when I look at comps, I often come in under what the subject property is actually getting today. In other words, I don't understand how they're getting what they are. She just says it doesn't make sense compared to the competition.
Interesting.
Yeah.
You got to look at, you got to get into the books. Are they giving out a lot of concessions to get there?
Right.
So, you have to understand, what the top line is does not necessarily reflect what they're getting. So you got to look at, your average effective rent and see if there's some concessions that's driving that.
Yeah. Yep. And then anything on the expense side? I mean, we kind of focused on the rent. Is that where the main changes happen on the rent side for you guys? Just making sure that your rent assumptions are adjusted and truly conservative, as opposed to just saying it's conservative. Any adjustments on the expense side? Are you putting in higher expenses because of inflation or materials, or what does that look like on the expense side? Insurance, whether it's
of course, insurance, taxes. We don't guess. We get insurance quotes while we're in due diligence. We hire a national firm to give us a tax estimate. We're not guessing. We're not just sort of getting on the county website and thinking we think it's XY multiplied by the millage rate. I want somebody who does this. That's all they do, is they evaluate tax impact on a daily basis. I'm going to pay them $1,500. They're going to give me a report that says best case, worst case, probable case.
Yeah.
So, I mean, those are the big ones, but, we are going to adjust our expenses given inflation. Payroll has been a massive issue. I mean, we used to hire a property manager, on-site property manager at tech for X. And now it's like, X times 30%. So you have to adjust for that. And in the same breath, you also have to figure out, how can we be efficient? Because most of the syndication world is third-party property managers. Some are vertically integrated. We happen to be using third-party property managers. But what we do is, I've got asset managers in-house that came from property management. So they're very well versed in reading financials and saying, okay, why are you spending X, Y, Z here? How can we be more efficient? Or for example, going the opposite direction, you've got an occupancy issue, and you get your financial report and you say there's no dollars spent on marketing this month. that should be a red flag and said, hey, why are we not investing in the right marketing? Because we have an occupancy issue. So you've got to be able to adjust expenses in your business plan, one way or the other. But the common theme is, again, back to granular, really understanding your costs, your underwriting, and staying on top of that of your third-party property managers, because they're not owners. They don't think like owners do.
No, 100%. And then speaking of expenses, it's kind of I see two separate questions. So I think they're all kind of tied together. Obviously, how do you evaluate the impact of changing interest rate? You talked a little bit about inflation, but also somebody was commenting about, here we go, any comments on the 0.25 rate hike? So let's break that up. What are your thoughts on the rate hike? If that really makes a big difference, it's only, now 25 basis point out of whatever it is, 500 to 525. Is that going to have a major impact on your underwriting moving forward? Or are you've already kind of adjusted a lot of the adjustments on what the interest rates have been over the past, 6-12 months?
Yeah, I mean, it has an impact. I mean, it's still heading in the wrong direction, right? But a lot of it is baked into the current cost of capital and cap rates. So you have to keep an eye on it. Everybody expected it. So if you weren't baking it into your underwriting 3 months ago and you're in the middle of a deal, well, shame on you, because it was to be expected. So yeah, you have to underwrite. So back to how our business plan has shifted. We're not doing much speculation or any speculation at all. So we have to buy for cash flow. So of course we have to walk into cash flow day one. So of course the interest rates affect us. We're not going to go into a negative leverage position. So, some guys are still doing that. And I'm not saying you're not going to make money. It's just an additional risk that Ashland does not want to take on.
Right. No, it makes sense. I know it's a good point. Anna was asking, in terms of you're not buying C-class, and we're going to get into the other asset class, but let me ask you, are you buying any multifamily, whether it's B or A, or have it's to the point now that you're on hold?
I would do, here's the one exception to C-class. I would buy a C plus asset in a B or A area. So if I can bring that to the next level. But what I won't do is buy a true C-class in markets that are C-class, and they're never going to be anything but that. So those are very challenging, and I think they're going to continue to be challenged. And then you get all into the sort of other areas of why I don't want to do it. We have a C-class asset that had a shooting the other day. I don't personally have the temperament to deal with that, to be honest with you. It's life is short, and there's some operators out there that have thicker skin than I do. That if they want to deal with that, great. But it becomes challenging, and I don't want to do it. So the short answer is we're not doing much C-class. We're doing B, A-class, and then of course we're heavily involved in student housing, which is it's a whole other business. I mean, it's people look at it as just another form of real estate. It is not.
I definitely want to get into the student housing part. So I mean, obviously C-class, I mean, I've always thought of it as a high risk, high reward. Like you got to deal with shootings and police, and it's all a mess. But on the other hand, you were at least in the past, arguably heavily rewarded for having to deal with that pain. But it sounds like that business model is starting to wane a little bit, because again, your whole business model on a C-class is to bring it up a little bit, make it from a C- to a C or to a C+, get those rents up, which then allows you to refinance. But between what you talked about, tenants not being able to afford the higher rents or getting really stretched at this point, in addition to people really not being able to refi anymore because they bought the property at whatever 3%, 4%, 5%, and now the interest rates are off the roof. It just doesn't pencil out. Sounds like the business model itself at the C-class level is somewhat broken, at least temporarily.
It is, and I think your comment about high reward, I think that was somewhat camouflaged by the market we're in. Free money, low interest rates, a very rapidly appreciating market. I mean, if you had a pulse as a syndicator, you could make money. So, I'm being a little facetious, but you know what I mean. It's and today is when the work really starts, and you have to know what you're doing to be able to execute a C-class value add. So it's much harder today from a number of factors: delinquencies, You know, once COVID relief money was gone, you know, your delinquencies shot up. Your court systems froze up. We have an asset where we've had residents living for 2 years for free because the courts are completely frozen up and you can't evict. So, you know, you get beat up a little bit by some of those dynamics. You learn, is it worth it? For me, it's not.
No, absolutely. I know you wanted to talk about asset management, so this is actually maybe a good transition to that. And by the way, if you're watching, you're getting some value, to hit that like button. It really helps us out and gets other amazing guests like Alix to come join us. But, you know, we had a guest, one of our good clients, Ashley Wilson. She did a whole episode, I think, on asset management. And one of her observations, which I thought was really interesting, was that, you know, a lot of operators, especially in the multifamily space, were actually getting their returns, and I don't want to say being bailed out, but basically getting a lot of their returns based on the cap rate compression alone. That if you actually looked under the hood and you looked at whether they hit the projections they had originally went for, if they actually got the rents they were talking about or actually got the occupancy up, you'd see that they missed all of those projections. But because of the cap rate compression, that's actually ultimately what caused the returns to be there, which kind of, like to your point, camouflaged the ability of this operator. Was it really the operator that did a good job, or really was it the market and the rate cap compressions that really got them through the returns?
That's exactly right. And you sort of so many operators didn't have to be under the hood really operating efficiently, and I think that a lot of them got lazy. All I can say is, you know, if you're going to invest in a deal, make sure that somebody's got dedicated asset manager on staff and they know what they're doing and their experience. You know, there's a company. There's not just, you know, a guy who's got a tech job during the day and at night he might be reviewing the third-party property manager's financials. You have to understand and know what those financials are saying to take action. Those are all indicators. Like the example I used earlier. If one of my asset managers looks and sees that there might be an occupancy problem and looks at the marketing budget, it's $0 or $100, whatever it is, that should be a red flag. Say, hey, we have an occupancy problem. We're not spending marketing dollars. What's going on here? I mean, that's a basic one, but there's so many parts of asset management that you have to understand and really know how to read the financials and push your property manager on a daily basis. It is a full-time, hands-on, intensive effort.
Yeah, just to make sure we're not leaving anybody behind, because I know a lot of times we have either new syndicators or new operators, but maybe talk a little bit about the difference between what a property manager does versus what an asset manager does, because I think a lot of people just think it's the same thing, but there really is a very key and distinctive difference. You want to talk a little bit about that?
Sure. Well, I'll just use, you know, Ashland, my company, as a use case. So, you know, we are the sponsors, the syndicator, and the asset manager. That's our role. So we're managing your money and we're managing the third-party property manager. So we hire a third-party property manager, but we are on the phone with them every single day, challenging them, supporting them. And a lot of them, you know, they're just like human beings. They need, you know, an attaboy. So it's you're a therapist, you're a CFO, you're a COO, you're all of it for them. You know, unfortunately, the real estate property management business can often attract, you know, pretty low level people. So you have to be completely on top of them. And they're not, as I mentioned before, they're not thinking like an owner, right? They're not thinking about exit strategy. They're not thinking about all these things that are much bigger picture. So an asset manager, their job, my asset manager came from property management, was a very successful number 2 guy at a firm and decided he wanted to get on the ownership side, came to work for us. But every day he's reviewing financials as they come across, leasing velocity, the renovation plan. Are we on budget? Are we on time? Any kind of challenges that they run into, checking for delinquencies, because those are the numbers. Those are the key data points that if all of a sudden you're seeing your delinquency climb, saying, what is my asset manager doing? I mean, even the best, just the other day as an example, we had a higher than comfortable delinquency on an asset. And we said, you know, what's going on? And, you know, the response from the property manager was, you know, we've called, no answer. Hopefully they'll pay. We'll just keep calling. And I said, have you knocked on the door? Do we know that it's not a skip? How do we know that that it's an empty apartment and it hasn't been sitting empty for 3 months because they were 90 days delinquent? And it was shocking. The property manager had not done his job, had not knocked on the door. Sure enough, we had some skips. So you just have to be on that stuff every day as an asset manager. So I mean, we can have a.
That's probably a whole episode. But how often do you meet with your property manager, somebody in your team meet? Is that a weekly thing, a daily thing, and maybe more importantly, has that changed over the last 6 to 12 months as things have gotten a little tighter?
Yeah. So on an asset that's going well, and we're stabilized, we're hitting all of our numbers. It's once a week. We're on a call with them for 1 to 2 hours. If an asset is in the stabilization period and we've got some key initiatives, or maybe it's a student housing deal where we're doing turn, which, getting rid of one whole host of students, getting the apartments ready for a whole another set of students, that's called turn in student housing, which is happening right now. It's the busiest time. We're on the phone with our property manager 2-3 times a week. So it really depends on what stage of the stabilization and any issues that are going on, and that's a standing meeting. But there's emails and random phone calls happening all day long.
Cool. And I want to get, by the way, to student housing next. If you guys have any other questions on maybe on the multifamily in general or other questions, drop them in the chat. I do want to get to the topic of Florida because I know that's been a topic lately. But Tice was asking, do you avoid the Florida market because of the rising insurance expenses, even though it's a high demand market? I literally read, what was it, a couple of days ago? There was another huge, I forget the name, you probably know, but the huge insurance carrier that just exited the Florida market. There's all kinds of reasons, or at least arguments as to why that's happening, whether it's man-made problem or it's just the reality of the hurricane season. But what say you, Alex? Do you avoid Florida? Do you have some investments in Florida? And how does the insurance impact it?
Sure. Well, we have a large asset, 936 beds at the University of Florida in Gainesville. So we bought it a couple of years ago, and certainly our insurance costs have gone up. Thank God we've had very good rent growth, 12% plus. So overall, we're still meeting our NOI, but not as much of that could be hitting the bottom line as we'd want because of insurance costs. So it's there. So I guess the question, do I avoid Florida? No, I don't avoid Florida, but I underwrite appropriately. And if the deal still works and the sellers know, the sellers are going through the same issue. So the sellers need to recognize that someone else is stepping into their shoes, taking on a risk. We don't know if it's going to be 25% next year, 30, and how many years does that last? So you have to underwrite for that risk.
And does it pencil out? Because I mean, I understand that that there's a higher cost, obviously, for the buyer, and the seller needs to, quote unquote, like you mentioned, needs to understand. But at the end of the day, if there's a lot of demand for the product, at least right now, the sellers tend not to reduce their prices. I mean, do the things still pencil with the ridiculously high insurance? Because it's not just the insurance, right? The Florida, like mostly it's hurricane, but the insurance rates are up. In addition to the higher interest rates, in addition to the higher cap rate, it's like you're just getting whacked from all different angles, right?
Right. No, it is harder. It is harder. And we haven't bought anything, in Florida for a couple of years. And to me, it feels like the majority of the buys that are happening with some speculation that somebody's just saying, look, I'm going to underwrite to 10%, insurance cost increases. And they're just hoping that it's not more than 10.
Yeah.
And they're willing, maybe they're well capitalized and they're willing to not cash flow if that should happen for X amount of years, wait it out and make less money. So if they can and they have that kind of conviction, great. But, my investors and myself, we want more of a predictable return. I want to be able to hit my projections and be able to distribute cash flow. So I'd rather not take that kind of risk. If I'm going to take that risk, I want the right price.
Yep. How much weight do you place? The question from Anna Gray. How much question do you place on a deal's ability to successfully exit the property in the specified timeline when deciding to move forward with a purchase?
That's probably the best question I think of that I've heard tonight, and I'll tell you why. That is an extremely important component of our decision to buy a property is the exit. So I'll just give you some student housing and non-student housing sort of dynamics. the shift right now in student housing is larger tier 1 schools, great sports programs. So if you buy in a smaller school, doesn't mean you won't cash flow, but you're taking a risk at the exit. And the risk is two. Number one, you're not sure what the exit cap is going to be. So it's hard to underwrite. Is it a 6.5 cap? Is it a 7? What is it? And the other thing is just general liquidity. So can I sell that property in 4 or 5 years when I'm ready? And if you can't, then you better have the right debt. I don't like that dynamic. I want predictability and to be fully transparent. We as sponsors don't get paid really until we sell. So if I have an asset that's illiquid, that doesn't bode well for the sponsor. It doesn't bode well for the operator, because you're sort of indefinitely holding on and not getting paid because you have too small of a market. It's illiquid. So it's very important. It's very important for us to underwrite to the right exit cap. So I'll buy in a secondary, tertiary market, depending if it's student or conventional. But I better know that the right cap rate, you have a different cap rate in the same market for C class, B class, A class. You're going to have a different cap rate if you're in student housing for a school that's 10,000 versus 40,000 enrollment. There's so many of those dynamics, and that's one of the most important pieces. How are you going to exit and at what price?
And how do you figure that out? Because, I've seen a lot of underwriting models where they basically just say, I'm just going to underwrite it as a 25 basis point increase every year. So if it's a, 3 or 4, if it's a 4-year deal, that's 2 basis points that they're going to add to. I've always thought it's just not a random guess, but it's really, how do you predict the future? Like if you're going to exit in 5 years, I mean, really, like how are you going to really confidently know? There's just no way to know, right? Or what's your process of trying to analyze what the exit cap's going to be in 4 to 5 years? I don't even know where I'm going to be living in 4 to 5 years, let alone what's the exit cap's going to be around here.
It's one of the hardest things. It really is one of the hardest things. It's an art and a science. And I think, when you at least look at the basics, right? And say to yourself, if today this market is a 5 cap market, maybe it's a 5.5 cap market, right? It doesn't really matter what you're buying it at. Too many people say, gee, I'm buying at a 6 and I've got to expand 10 basis points per year. So I'm going to exit at a 6.5. That is the generic,
right.
Underwriting tool that most people use.
Right.
It doesn't really matter what you're buying at, because you might be buying something that's unstabilized, right? Then you're going to buy it at a 4 cap, stabilize it at a 6. But it's still historically been a 5.5 cap market. Now, that interest rates have gone up. So you have to adjust for it. You have to be a little bit of a fortune teller and say, what confidence do I have that, in 5 years from now, interest rates are going to be 3%? I'll tell you, I have no confidence. But could interest rates be, 5? Probably. So should I underwrite to a 5.5 cap? It's likely defensible. And then, so if you have a baseline, and then you're going to adjust. Is it a primary market? Can I have a lower cap rate? Is it a secondary, tertiary market? Do I need a higher cap rate? Is it a 30-unit deal or is it a 300-unit deal? Varying degrees of cap rates and potential buyers. So you really have to think about who is your buyer? Who's your end buyer? Is it a private equity group like us? Is it institutional? Is it a high net worth family, a mom and pop? What is it? All those things will sort of inform you on the overall investment thesis. But there's data out there. So you go back to CoStar, you go back to different platforms that will say, okay, this market is a 5 cap market. It's expected to grow, rent growth 3% a year. There's data points that you can use to help, inform you of what a defensible cap rate is.
Yeah, it's interesting because that's such an important question. Also, if you're an LP, and I know you're a big LP investor, you invest in a lot of syndication yourself, as am I. And so that's one of the really important questions for you to be asking is like, not only what is your assumed exit cap, which is going to be in the business planning somewhere, but really what is that based on? Like at the end of the day, as an LP, I think you always should be asking what's the underlying assumptions between, of all these numbers. We always try in our docs to put the underlying assumption because that's really, really important. But because you're such a big LP investor, Alix, I wanted to maybe pivot a little bit to the LP side a bit. And what do you think when you're putting your hard-earned cash into somebody's deal? What are sort of the 2 or 3 biggest things you look for And you can't say due diligence on the sponsor because that's obviously the big one. And that's, I've been talking about that a lot. Obviously, the due diligence, what the sponsor, their level of experience, all that stuff. That's kind of the obvious one. But you've got a couple of interesting other metrics you look for that I want you to share with our audience. So if you're an LP investor out there looking, what are the things you look for in a specific deal or a specific sponsor team?
Well, number one, as it relates to the Facebook world and some of the groups and people that we run in the same circles, I would never invest in somebody who's not full-time. You have to be a full-time and you have to have a team. I personally never invest in a single operator or somebody who's not full-time. The typical guy who's, doing IT during the day or fix and flip during the day. And, there's cobbling together some guys boots on the ground. No way, not for me. Not that they can't make money. I have friends who are those guys who have just gone through the cycle of going full-time, getting rid of the W-2. They can be successful. But if I have a choice, and I have a choice, I'm going to pick the best. And they don't have to be the biggest. In fact, I like mid-sized companies where the principals are very much involved in the business, have a very good pulse on it. But there's a company behind the sponsorship. It's not one guy. So if I get hit by a car, there's 3-4 more key members of my team that are full-time employees, not just this, ABC real estate and XYZ real estate coming together on this deal. There's a consistency. It's a company. You know what I mean?
100%. Doesn't ask about the size. Okay, good. So you won't invest with somebody who's not full-time. What else do you look at in general?
So I look at, do they have experience in that asset class? So, I think, I forget the cliche. What are you, a master of none or something along those lines? The guys who are, one day they're buying self-storage, then it's retail, then it's student housing, then it's blah, 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 blah. It's like every month they have a new deal. I'm not comfortable with that because I just don't think they know the asset class well enough, much less the specific markets and sub-markets that they need to know. So that for me is really important. And then I'm going to dig into the underwriting, and I want to make sure that all those assumptions are defensible.
Right.
So, for me, it's easy, right? So as I look to invest as an LP, and interestingly enough, I generally invest as an LP in asset classes that I'm not in. So it makes it a little bit more challenging for me. Like, I've invested in industrial. I've invested in some medical office because it's not what I do and I want to diversify.
Right.
If I'm going to invest in student housing or conventional, putting money in my own deals. But still, I've invested in others. So I'm going to look at the cap rate. Is that defensible? I'm going to look at, are you walking in to cash flow day one? That's going to be important for me. Is there any speculation to the deal? In other words, are you going to take $1 million of NOI from the T12 and expect to grow that to $2 million in 18 months? That all those things. There's a bunch of red flags, and that causes a dialogue, at least for me, with the sponsor. Say, hey, I notice you're growing your NOI. How are you getting there? Oh, we're going to raise rents by $200. Okay, how are you going to do that? Well, we're going to renovate. Okay, how many units are you going to renovate? Okay, how long is it going to take you? What are you assuming, you're going to have your X amount of units offline, right, while you renovate? All those questions lead to some sort of, gut feel, not gut feel, but a confirmation that doesn't jive. There's no way you're going to renovate that type of scope in 1 week, multiply by X units. You're just not going to do it, right? If there's enough of those like, that's aggressive. No, thank you.
What about skin in the game? How important is it for the sponsor to have skin in the game? And if it is important, how much? $5 or
Yeah, I think it's important. I always want to have sponsors have skin in the game. I've invested in every single deal that I've ever sponsored, so it's important. Sometimes it's not even. I look at skin in the game could be a number of things. It could be, what does the sponsor have to lose? Do they have a long track record and a reputation and a real business? That guy, number one, he's probably well capitalized. So if something comes up, he may reach into his own pocket and loan the company money. he may and have the capacity to do things that a newer sponsor that's not well capitalized nor experienced is able to do. So I look at what kind of skin in the game they have from that respect, reputational risk. And then, of course, I want them to have some skin in the game. But, I've invested with groups that have been doing the business for 30 years, and they'll have 5% of the equity up. And I've seen guys that do 20% of the equity. So that's not a huge,
not a deal breaker. Yeah, so it doesn't sound like it's a deal breaker. And how long does it take you to do this? I mean, how long do you spend if I had a deal and I'm like, Alex, I got a deal, let me send it. Do you mind if I send it over? You can take a look at it. Is this like a couple hours in a day, or is this a couple of days? How long does it usually take you to yay, nay a deal?
I mean, I can look at a deal and likely in 30 minutes assess if it's worth a deeper look. And if it's worth a deeper look, then I get interested. Then I might spend another hour going through the numbers and talking to the sponsor. And then, and I'm usually comfortable. I can usually spend a couple hours in total. And if I'm not, and all of a sudden I start, questioning, and having to call and verify, third-party property managers or whoever on certain assumptions, then either I'll get deal sort of DD fatigue and just pass, or it'll be a sign that I'm just not comfortable.
Sounds good. All right, let's get to the student housing, because I know this is an asset class that a lot of people have been asking about lately. I thought it was a kind of an easy asset class, but I've been told it's not. Let's just go. Like right now, multifamily versus student housing. I think you're going to tell me you're kind of into the student housing. So maybe talk a little bit about the difference and why you think right now student housing is your asset of choice, whether right or wrong.
So, maybe I'm a glutton for punishment, but student housing is much more work. It's a business. I equate it to more like assisted care. Assisted care. You've got nurses. You've got food and beverage. It's a full-on operation. That's student housing is closer to that. So you have to understand that demographic. You have to understand college kids. You really just have to know what you're doing in terms of operations. We're not a third-party property management company. We use one, but my property manager, my asset manager came from student housing. He was the number 2 guy that I mentioned. Understands that asset class very well. I've rented to students for 20 years. I used to have a portfolio of single family college rentals. So I kind of cut my teeth with that demographic and then slowly graduated to buying larger institutional sized assets. So it's very different. It's if you don't lease up by mid-August, you're dead, right? So you don't have, you could backfill a little bit. You might have international students come in late, second semester students, et cetera, but you've got one shot. So, that part is very different. You're leasing by the bed. You're not leasing by the apartment. So you've got multiple leases. You're dealing with roommate issues. Jackie stole my ketchup and Johnny's getting stoned. Whatever you can think of happens in student housing. This guy's partying. So you have just all that. And you have to understand how to navigate that whole process.
So is it like the Class C we talked about a few minutes ago? Like it's a higher, maybe it's not a higher risk, but it's just a higher workload. You're a glutton for punishment, but on the other side, the returns are better. Is that the assumption I'm making?
So you have different types of risks, right? So your delinquency risk is much less because you have parental guarantees or you have a student loan behind that student. So they're generally paying. That's the beauty of student housing. You can count on that money. You got to chase them a little bit just to make sure they pay on time. But generally, they're paying. Your delinquency is nowhere near conventional. So that's one of the benefits of it. Your ability to raise rents is also better than conventional, because if you think about it, put yourself as a parent. Your kid's going to school. Your kid's living in my complex, and they're paying $800 a month per bed. And then next year we say, okay, we're raising rents by 10%, and that's $80 out of Mauricio's pocketbook per month. And you say, okay, times 12 months, $1,000 for a place that my kid wants to be at. They've got friends, they've got good roommates. So that acceptance, that tolerance for raising rents, as long as you're competitive in the market. Yeah. Is much more successful than conventional, because you've saved that money for your kid. And generally, we deal with kind of a mid-range or upper range demographic. So kids have money, their parents have some money, and I hate to say it, but they're a little bit easier to deal with.
Yeah.
So you have to understand the dynamics of all that. So it becomes very, very nuanced. We like it. We understand it. There's less competition in student housing, and there's a lot more failures. So the conventional guys that move over think, oh, I'll just hire a third-party PM. It's just like conventional. They know what they're doing. Boy, do they got a surprise coming for them. and it's called, the underwriting process is like 3 times harder. Having said all that, we love it.
You love it.
We understand it, right? We've been very successful at it.
Yeah. What about, by the way, if you haven't subscribed to the channel, really would appreciate the subscribe. If you're getting any value out of this talk, it's amazing talk with Alix. Biggest pushback I think I've heard, just to kind of give you a hard time, the biggest pushback I've heard from student housing is just, what's going on with university enrollment, with all this, with COVID that happened a couple years ago. I think that was a big hit for you guys in general. Maybe I'm wrong, but obviously when COVID hit and everybody shuts down and everybody's moving to online, talk a little bit about that counter argument as to, the risk is that, the schools, their enrollment starts going down and you've got less demand for your product. Great
question. So COVID hit, everybody freaked out. School shut down naturally, and we thought no one's going to pay. And everybody moved out. They went home. That was the initial reaction, panic. We found out that people continued to pay because the parental guarantee, because wealthier parents don't want bad credit. The students did go home for a little bit, and they said, you know what? I don't like hanging out in my parents' basement. I want to go back to my private apartment on campus, live with my friends. We'll wear a mask, where we won't wear a mask, whatever. We're fearless. And so that's what happened. So they all basically came back. They were living at our apartments and paying rent. So it was a short blip, I should say. What's happened and in fact, what's happened is parents and students became much more sensitive of having private rooms, their own bathrooms, equal bed bath parity. So we actually saw a surge of demand coming out of COVID for the type of apartments that we buy. People didn't want to share bedrooms, they didn't want to share bathrooms, and that all bode well. The biggest change is what I call just a consolidation in the industry. So the smaller schools are getting hurt because someone says, hey, if I can go to school online and probably do that for a lot less money than going to a half-assed school, but I'll never get the same kind of education and the social experience and the sports programs as a major university. You can't replace that. You're not going to get that online. It's just impossible. And there's still a very, very big demand. So the kids that went to the small schools, they said, this might not be for me. I'll either go to a junior college or go online. But the majority of them just shifted their preferences to the larger schools. So that's why you have to understand what's going on in the market. If you buy in a smaller school, you have risk. So you're constantly having to gauge the enrollment growth, what's happening with the school's master plan, what's happening with the supplies or new development. So there's that whole dynamic. Yeah, good. Well, we got a couple more questions. We're running out of time here. We've got a couple questions here that I still want to get to. But before we do that, if somebody wants to get a hold of you, what's kind of a good place for people to find you, and if they got some either follow-up questions or want to get in touch with kind of what you do? Sure. The website is ashlandcapitalfund.com, and my email is Alix with an I at ashlandcapitalfund.com. Yeah, and I think here we go. That's the website, Ashland Capital Fund, and you guys, how long has Ashland been around? So the Ashland brand, so to speak, has been around for about 5 years, but under different entities. Obviously, I've been buying real estate for 20 plus years. Right. Well, good. And we do have a couple last. You got a few more minutes, Alix, before we call it a day here. Absolutely. Let me just. I know VTL. Do you do any triple net lease stuff? No. Yeah, there you go. And then you mentioned CoStar a few times. Is that something that you really believe in? Like I have heard this before in terms of how reliable is CoStar in your opinion? It's just one data point. But what we always do is actually call. So you start with figuring out what your comps are, then what you want to do is you want to call the comps, because the average effective rent, excuse me, on CoStar may be different than what's actually happening on the ground. So you actually want to mystery shop, you want to call, and that's how you can validate where rents are. And a lot of people are fluctuating and changing rents seasonally. So that's the other thing that I think a lot of sponsors are missing. Don't forget about the seasonality. I may be getting $1,200 in the middle of summer, but if I'm trying to rent that unit in the middle of winter, less traction, I might be at $1,100.
Yeah. So from what I've heard from you today, which is two great things. One is obviously trust but verify. So you get this as just one data point, pick up the phone, call, and then just use a lot of different data points. It's not about just checking with your property manager, just checking CoStar. You got to check them all. You got to do some real work.
People forget that this business is work.
Well, hey, Alex, really, really appreciate your time. Again, ashlandcapitalfund.com to check out more information about Alex. And also, if you want to join us in our Facebook community, which I know Alex is a part of, you can go to mauricearol.com Facebook group. It's the real estate syndicator community, just an amazing community. I'm there all the time answering legal questions, or my not legal advice, but I'm answering some legal questions, and really great supportive community there. So if you want to go check out the community, it's the real estate syndicator community at mauricearol.com/Facebook group. Alex, thank you so much for your time. I know you're super, super busy. Really appreciate you on behalf of our community, and looking forward to having you for a third time here in the near future.
I appreciate it. Great to be here. Thanks, Mauricio.
Thanks, buddy. Appreciate it.